Hey everyone, Jack Burdey from the Schaefer financial team here, filling in for Chris this quarter. Chris is on some well-deserved holidays. He's up at the family cottage, enjoying the sunshine and getting on the water. So I'll be going over some slides, giving you some insights from our team of what we see in markets and go over some performance. So I will share my screen and we'll jump in. Perfect. So taking a look here, we'll start off with Canada. So the TSX Composite, the widely followed Canadian stock market index, is up about 11% year to date. In the US, the S&P 500 is up about 9.3, and a widely followed international benchmark, the MSCI EAFE, is up about 9.6% as well. Now, there's a lot we can go over here, but I want to kind of just touch on a couple themes. The first is that we're seeing fairly widespread performance that's similar. So for the last few years, since about 2021, 2022, we've seen a lot of narrow leadership from large US companies. So the S&P 500 especially, and its tech heavy, growth heavy NASDAQ index have largely outperformed many other areas of the globe in terms of stock market performance. We're starting to see that broaden out a little bit. So as you can see, the main indices are all up roughly equal. And a couple things that stick out to me is small caps. And in the US, the Russell 2000 small cap index is actually outperforming the large cap equivalent. In Canada, the small cap and the venture, which is the even smaller cap companies, are both in line or outperforming the larger caps as well. In addition, the second point I wanted to, or second thing I wanted to point out, sorry, is emerging markets. Emerging markets is up about 25% year to date. So it's had a very, very strong year. Now, part of that is due to, again, narrow market leadership within emerging markets. Some of the large semiconductor companies are considered emerging market companies. But as we can see, even looking internationally, a lot of performance is broad across the globe and across different areas of the market rather than just those top 10 US companies, which for the most part, since again, 2021, 2022, have driven most performance. As we look a little deeper here, just diving into both Canada and US on the sector level, no surprise here with the Iran war going on, there's been a huge supply constraint in oil, which has driven energy prices up. This is positive for energy companies and the energy sector. So in Canada and in the US, energy is one of the best performing sectors. However, in Canada, financials, all the big banks and financial institutions, those two sectors have had the best year to date numbers, and they collectively represent what 47% of the index, 48% of the index. So that has driven a lot of the TSX composite return year to date. There's actually more sectors underperforming the broad market than not, but given the composition of it, that is why the TSX is up so far. In the US, we're seeing the same story with energy, but industrials and information technology are also having very strong years. Again, looking at composition, they between industrials and information technology, they represent about 42% of the index. So when they're doing well, the whole S&P 500 index is being pulled up. Same story, many sectors underperforming the broad indice, but that is one of the main reasons why the index is up 10.1%. So moving on just to a couple themes and insights we're taking a look at. I wanted to take a moment and take a step back and look at things from a high level because it's easy to get caught up in so many headlines, especially with everything going on in the US, with Trump's term with Venezuela and the Iran war, the trade war, tariffs. There's been so much noise, but it's important to remember what it is that actually drives market performance. And over the long run, what drives market performance is earnings. Stock market is just and the benchmarks like the S&P 500 are just a big collection of stocks and their representative share. Those stocks are just businesses. And what drives business performance? Well, it's revenue, how much they can sell, their sales, and then how much they can keep after costs, which is their earnings or their earnings per share. So stock market is just stocks, which are businesses, and that business performance is based on their earnings. So if we look at the long run, this blue line here is the S&P 500 earnings per share of all the underlying companies. See this blue line going up over time. This yellow line is the total return of the S&P 500 index. As you can see, they are very strongly correlated. There's some periods where that dispersion widens, but over the long run, they are highly, highly correlated, meaning that whatever the companies are doing, however they perform with their earnings, the market typically follows. In the short term, we can have huge periods of swings and things going on with headlines and lots of noise, but over the long term, if earnings are growing and earnings are strong, markets tend to follow. I wanted to mention that because I want to take a look at 2026 earnings and earnings projections. So for the S&P 500, consensus earnings per share was 26% for the first quarter, 18 for the second, 22% for the third, and 20% for the fourth. That is earnings growth expectations relative to 2025. Looking at the 2025 numbers, that's almost double. Our expectations for earnings this year were almost double what they were last year. When we look at an annual basis, that's these three bars right here, 2026, 7, and 8. The earnings expectations growth was 24, 17, and 15% respectively. That's significant. Those are large, large expectations for earnings growth. We'll explore where that's coming from in a moment, but the story itself is that earnings expectations were strong, and so far throughout the year, that has come to fruition. Earnings have been strong. So lots of noise, but companies are growing their earnings, and their stock prices are reflecting it. Continuing, where those earnings are coming from, it's not just the Meg 7, those top 10 companies. So looking at this chart on the left-hand side, starting in about April 2025, this is earnings breadth, meaning the number of companies that are growing their earnings versus the number of companies that aren't. We're seeing the strongest breadth since 2021. So more companies beyond just, again, the Meg 7 top 10 companies are growing their earnings versus not. So we're seeing this broadening of all these companies doing well. In addition, this is the net income year over year change. This is Meg 7 in blue, and this is all the rest of the 493 companies in yellow. Starting in around 2023, well, I guess 2022 actually, you can see this increase year over year in earnings or net income change, to the point where in 2027, earnings growth for the Meg 7, which again, Meg 7 are the Apple, the Amazons, the NVIDIAs of the world, earnings growth for the other companies and the Meg 7 are expected to be equal, which is something we haven't seen for a very long time. So talking about just general risks to what's going on. So obviously earnings are strong. There's lots of headlines, but what are some of the risks to, the market? Because the market has held up well. Well, obviously AI. AI is the big one, and then the valuations that come with AI. So this is just a chart showing performance of AI stocks versus tech sector versus the S&P 500. Now, the tech sector has always historically been capital light and has produced high profit margins for successful companies. So it earns a bit of a premium. However, the AI stock craze has gone quite wild. How is that reflected into the valuations of the companies? Well, we've shown this chart before. Chris has gone over this, but the 30-year average for the S&P 500 is about 17.2 for its PE ratio, which is just a way to value the price divided by the earnings of the companies. A way to value whether the market is overvalued or undervalued, whether it's cheap or expensive to buy. Since about 2020, with a dip in 2022 when we had a negative year, we have been in a historically high earnings PE ratio environment, sorry. That doesn't necessarily mean we're going to see a huge pullback or a huge contraction or bear market, but it does just mean that the market is pricing in higher valuations for this new wave of tech-heavy companies, AI-themed focused companies. When we dive in a little bit deeper, we look at where is that the PE ratio of the market, comparing the top 10 companies, the largest weighted, versus the rest. What's the difference? So the top 10, again, these are like the Mag 7, the Apples, the Amazons of the S&P 500. Their PE ratio at one point was over 34 times in about 2020, 2021, whereas the rest of the market was at about 19.6. Fast forward to today, we are at 21. Oh, sorry, no, they were at, about 19.6. Fast forward to today, the top 10 companies are trading at around 21 times earnings, whereas the rest of the companies are at about 20. So that margin has narrowed significantly. And the reason I'm saying this is because Number of years ago, before companies were spending a lot on AI, these were very capital light businesses. It didn't take much for them to keep investing and earning huge profits. Over the last few years, they have been putting huge amounts of money into AI development, and there hasn't been strong, tangible returns yet on those investments. So the market is pricing in a little bit less of a premium for these companies, given how much they're spending on AI. This chart here shows the capital expenditure, so how much money they're spending on AI from only the top companies: Alphabet, Amazon, Meta, Microsoft, and Oracle. 5 companies. Their expected spend on AI went from 416 billion in 2025 to an expected 986 billion by 2028, almost $1 trillion. That is a double from 2025 to 2028, a double 2 years, and a double from about 4 years before that. So it's an exponentially high amount of spend. Where's this money coming from? Well, again, they were really profitable companies. This is their operating cash flow, so the money they just make from running their business. That's where most of the capital expenditures come from. They've just been using how much money they make up until recently. Their free cash flow, this gray line here, it's hitting a near 0%. And that's because they're using all of the money they have, their operating cash flow, for AI. So their free cash they have available is almost nothing. So they're starting to tap into the debt markets. That's something that markets don't like. They don't like when debt is funded for projects that they don't know the return on yet. So that's one of the reasons that valuation has come down. In terms of volatility, what does this mean? Well, markets are high in valuation. The companies are earning a lot. They are profitable. They are doing well. But there is a risk that, those valuations become high. The investments don't come to fruition the same way that they expect. AI maybe doesn't see profitability and increase in productivity to the same degree. We maybe see pullbacks in the market as investors get a little nervous. And that just tends to lead to more volatility, more swings in the market. But I wanted to bring up this slide because volatility is normal. Chris has shown many times the slide of year over year what markets do and what is their average drawdown, or not their average, but what is their drawdown for the year. And markets could be up 20% one year, but have a drawdown of 13% mid-year, because that's normal market behavior. This is another way of showing that. This is the number of S&P 500 stocks with a drawdown of 5% or more during the year. So on average, in 22 of 30 years, about 75% of all the stocks in the S&P 500 index had a drawdown of at least 5%. Meaning, in layman's terms, if you throw a dart at a dartboard with all the companies in the S&P 500, you have a 75% chance of hitting a stock or a dart that company would be down at least 5% during the year. So especially in actively managed portfolios, if you go line by line, you look at positions, you might think, why is this position down? Well, it may be down 7% at one point in the year and finish 13% up. Stocks are volatile. The stock market is volatile. But in actively managed portfolios, you're investing in those companies because you have expectations that they're going to continue to grow, they're going to continue to become more valuable, and the stock is going to earn a higher return, which historically is true. One more thing I want to touch on, we talk about it frequently, but we are global investors. Chris and I do like to have a large allocation to outside of the US, so Canada and international. And this is just a couple notes on international equities. So we've shown this chart before. Anytime this purple is above the line, this is international outperforming the US. Since about the great financial crisis, essentially, US has had a strong bull run, and they've done very, very well, with some periods of international starting to come back, but then US continues to outperform. Since about 2024, we have seen international start to really pull up to the point where we are starting to break out of US outperformance. International has outperformed US since about 2024. This chart here, if we work our way down, when this line is declining, this is all the world indices divided by the S&P 500. So essentially, if it's going down, US is outperforming. If it's going up, US is underperforming. US has outperformed all the way until about, end of 2024, and international has begun to outperform. When we look at why that is, well, historically, US companies have been more profitable and more productive than other companies. US is very capitalism focused. They favor profitable companies and invest lots into them to allow them to grow big. And the regulations tend to be fairly low compared to a lot of companies. So they have earned a premium in terms of what they should be valued at. Their earnings growth has been a bit higher because they've been more productive. That's this black line, US companies, whereas the rest of the world is less productive. That has come to a consolidation point. They currently 12-month forward expectations on earnings are the same for international companies and the US. However, valuations, which we talked about, non-US companies are 30% cheaper than US stocks right now. For, let's say, like in a simplified example, two lemonade stands, one's in the US and one's in Europe. They both are expected to sell the same amount of lemonade. I'm going to offer to sell you both, but one of them is going to be 30% cheaper. That's kind of the rationale behind, hey, earnings are the same. These companies are just not valued to the same degree because they're not based and listed in the US. Overall, that was all we had for you. I tried to keep it light. I'm not quite as seasoned in this area as Chris is. He is the expert in doing these videos and touching on the market. So I hope I was able to fill some big shoes there. He'll be off for a little while, enjoying, like I mentioned, the hard-earned vacation. So if you have any questions, reach out. I'd be happy to answer. And if not, when Chris is back, he'd be happy to chat with you. So thank you for listening, and I look forward to speaking with many of you guys soon. Take care.